2 weeks ago, a team of PACE economics students came in first place in the New York Federal Reserve Bank's College Fed Challenge, which is a team competition for undergraduate economics students about monetary policy, and it's modeled on the workings of the Federal Open Market Committee, which is the primary policy-making body of the Federal Reserve. So they came in first. Last year they came in second, both quite extraordinary achievements. Because they were first, they went this week to the national competition in Washington with 5 other colleges and universities and placed third. That's third in the nation among over 130. So, great. So this team is with us today. Here they are, right? Among that group may be a future leader of monetary policy in America. They're not quite there yet, but Bill Dudley surely is there. And as president of the New York Fed and a member of the Open Market Committee, he is among the most senior policymakers formulating American monetary policy. Earlier, I mentioned that many PACE alumni, hundreds really, have worked at the New York Federal Reserve Bank. One of those of whom we are most proud is Edward Murphy, who is not only an alumnus but a trustee of the university. Ed is currently executive vice president of the bank. He heads the corporate group, among a really quite broad range of responsibility that entails. He is the chief principal financial officer and a member of the bank's management committee. I'm very, very pleased to welcome Ed Murphy, who will introduce President Dudley. Thank you very much.
Thank you, President Friedman, for your very First, I want to congratulate the team that came in third place in the national championship. You guys do the university and the whole student body and the whole second district very proud. Congratulations. I'm delighted and honored to introduce Bill Dudley, who has joined us today for what will be, I'm absolutely positive, a very stimulating discussion. And I'm especially pleased to address you since, as President Friedman mentioned, I have important personal and passionate ties to both the Pace University community and the Federal Reserve Bank of New York. Since 2009, Bill has been the President and Chief Executive Officer of the Federal Reserve Bank of New York. In that capacity, he serves as the Vice Chairman and a permanent member of the Federal Open Market Committee. And that's the group responsible for formulating this nation's monetary policy. And Bill also plays an important role, leadership role, in the international scene. And in 2012, was appointed the Chairman of the Committee on the Global Financial System of the Bank of International Settlements. Bill joined the bank in 2007 and served then as the Executive Vice President in charge of our markets group, which oversees domestic and open market and foreign exchange trading activities for the entire Federal Reserve System and provides account services for foreign central bank. He also managed the system's open market account for the FMOC. His illustrious career includes a decade served as chief U.S. economist for Goldman Sachs, where he was a partner and a managing director. He has appeared on CNN and the Nightly Business Report and is frequently quoted in business publications, including The Economist and the Wall Street Journal. He holds an economics doctorate from the University of California, Berkeley, and a bachelor's degree from New College of Florida. Please join me in welcoming Mr. William C. Dudley.
Before I start my formal remarks, I just want to say that we have a lot of PACE University grads besides that at the Federal Reserve. I think by the count I was told this morning, 128. That's not an official count, but that's the count that I had. And we think it's a great place to work. So I want to just turn aside from my speech for a moment and make a little recruiting pitch. We think we have it's a great place to work, very challenging work across a wide variety of different activities. So if you do have an interest in working at a really good place with a good culture, contact us because we would be interested in your interest. So it's great to be here to address all of you, students, alumni, faculty, university supporters. I always like speaking to academic audiences who I find to be particularly well-informed and attentive. And of course, I also want to commend the students who did so well winning our second district Fed Challenge and doing extraordinarily well in Washington with a 3rd place, which I think is an excellent performance. So what I want to do today is I want to talk a little bit about the Fed, what we do and why we do it, and then I'll provide some thoughts about the national and local economic outlook and monetary policy. In covering the region and the nation, I am going to focus on the terrible impact of Sandy on the region and the implications of Sandy for the national economy. I know I will fall short in acknowledging all the hardships that our fellow citizens have endured, including the devastated loss of loved ones, homes, communities, livelihoods, as well as widespread problems caused by flooding, disruptions to power, fuel, food, transportation, and other services across the region. And I think I will not be able to fully commend and compliment the ways in which family members, neighbors, coworkers, and strangers have helped those who have been most in need. I am deeply moved by the evidence of how people have reached out and pulled together across the region. In terms of Sandy and the recovery process, New York Fed is very much involved in that effort. In addition to our economic analysis, we're convening advisory groups and our regional contracts to really receive firsthand accounts in terms of what's happening in the ground in terms of the impact on communities, families, and businesses, and to really assess ways that the New York Fed can be helpful. So, for example, we're holding a clinic in Staten Island to help people obtain information about the different types of financial support that may be available for them. And we're also encouraging banks to show appropriate flexibility when dealing with small businesses and other borrowers who have been impacted by the storm. After my remarks, I'll be happy to answer any questions you have about what the Fed does and why, and about the economic outlook. But I'm not going to comment specifically on the upcoming FOMC meeting next month. And as always, what I have to say reflects my own views and not necessarily those of the Federal Reserve System or the Federal Open Market Committee, often referred to as the FOMC. So by way of introduction, I'm going to briefly review what me and my colleagues do at the New York Fed. The New York Fed is one of the 12 Federal Reserve banks that together make up, with the Board of Governors in Washington, the Federal Reserve System, and that constitutes the nation's central bank. The Federal Reserve is independent within our government, and by law we're charged with managing the nation's monetary policy, taking actions to raise or lower interest rates to promote full employment and price stability. The Federal Reserve is also charged with promoting financial stability because without financial stability we cannot achieve our other economic objectives. We also play an important role in the nation's payment and settlement system, what some people call the financial market plumbing. For example, we help ensure that banks' ATMs have cash in them, and that when you write a check to someone, the money will actually move to that recipient when that check is cashed. In addition, we do have a specific mandate to try to work to promote economic development in each of the 12 Federal Reserve districts. Now, as president of the New York Fed, I serve as vice chair of the FOMC, which meets in Washington 8 times a year to set interest rates and make decisions about monetary policy. The members of this committee all strive to achieve our statutory objective of full employment and price stability. Sometimes, though, we do have different views on the specific policy choices at hand, and our policy decisions do reflect a full discussion of those differences. And I think this diversity of viewpoints is really a key strength of the Federal Open Market Committee. In fact, I believe we make better decisions as a committee because we don't all think alike. But we are united in our commitment to the dual mandate of maximum sustainable employment and price stability, and in our belief that preserving the independence of the Federal Reserve is in the nation's interest to make monetary policy. That independence allows us to make tough decisions based on data and analysis insulated from short-term political considerations. So what happens at the FOMC meetings? Well, at the FOMC meeting, each committee member presents a current outlook for his or her district and for the nation. And to formulate these assessments, what we do is we consult from many sources: our board of directors, regional advisory council, community leaders, other key stakeholders. And we travel around the region. We come to venues like Pace University today, and we chat to people to really understand what's happening on the ground in terms of what's going on in terms of the economy. To add to what I learned from these conversations, my colleagues and I at the New York Fed continually track conditions in the district. We've created special tools for that purpose. For example, my staff tracks local household credit conditions, including the amount and type of personal debt and whether repayments are being made in a timely fashion. We also conduct a periodic poll about the credit needs of small businesses, which are an important source of new jobs in the district. So if you do happen to have an association with a small business and would like to participate in the next poll, let us know. Pass a card to me or one of my colleagues, and we'll make sure that you get plugged into that survey process. To promote growth in our local communities, we publish a lot of data and analysis about the local economy. We also provide outreach initiatives, including workshops on how businesses can gain access to global markets. And we also try to have activities to help businesses learn about loan programs and sources of credit enhancements. We also run an annual video festival for local college and university students. In this program, student teams produce videos that aim to help educate young people about financial literacy so they can make sound personal financial decisions. A panel of advertising and video professionals select the winning video productions, and then these videos actually get shown in local movie theaters. Now, as you know, even regions as wealthy as ours have large pockets of poverty. So we also target some of our work specifically to low and moderate income groups. And we've worked hard to help neighborhoods that face high foreclosure rates. This fall, for example, we hosted a conference on distressed residential real estate to share a new expert analysis with senior policymakers and practitioners from across the country. And later today, colleagues from our research department will provide a press briefing on the housing outlook in our region as a whole. Next week, we're going to be holding a workshop so we can better understand the factors that are limiting the pass-through of lower yields on agency mortgage-backed bonds into primary mortgage rates that are offered to borrowers. We will then be in a better position to evaluate what steps, if any, might be taken by the relevant authorities to contribute to a greater pass-through into primary mortgage rates. So now let me turn to the regional economic outlook. Our region's economy was on a moderate upward trajectory before Sandy struck. And while the storm had many severe effects, and I'm going to discuss this in a bit more detail in a few minutes, I do not expect the storm will derail the region's ongoing economic expansion. New York City's economy has been performing quite well. Employment in the city reached an all-time high at the beginning of this year, and it's continued to grow briskly since then, even without the help from its key financial sector. While job growth has been considerably more subdued in the surrounding areas, such as Long Island, northern New Jersey, Fairfield County, and the lower Hudson Valley, many workers in these areas commute to New York City for their jobs, so strength in New York City is helpful to the region as a whole. Still, it's true that the unemployment rate in the city remains high, above 9%, and this is something that needs to improve. Upstate New York, the economy is also generally on a positive trajectory, although some areas have fared better than others. Albany, Buffalo, and especially Rochester and Ithaca have recouped many jobs lost during the recession, while Syracuse and Binghamton, on the other hand, have lagged a bit behind. Looking beyond the employment statistics, I also see other encouraging signs in the region. Housing markets have improved. There has been a noticeable pickup in multifamily construction, both in New York and New Jersey this year. However, not all the signs are positive. The New York Fed's measures of regional credit conditions suggest financial challenges continue to persist for families here. Data we just released for the third quarter of this year show that for those individuals that have a credit report, average debt per person in New Jersey was $61,000 and was $49,000 in the state of New York. Overall, debt per person peaked in 2008, and while balances nationally have fallen by 11% from the peak, for consumers in New York and New Jersey, the indebtedness has not fallen as much, declining by only 5% for New York and 6% for New Jersey. So about half the decline that we've seen in the nation as a whole. Now, while overall delinquency rates on loans are decreasing nationally, delinquent balances in our region have remained stable or even increased a bit. So in New York and New Jersey, nearly 9% of all balances are 90 days or more delinquent, and that's above the national average of 6.5%. Now, although there have been some signs that home prices are starting to firm, the housing crisis is by no means over in this region. Delinquency rates on mortgages in New York and New Jersey remain considerably higher than for the nation as a whole. Now, before discussing the national outlook, let me talk briefly about the effects of Superstorm Sandy on the U.S. and regional economy. The damage and disruptions from the storm do appear to be more extensive and longer lasting than what we first anticipated. Now, of course, there's the physical damage, which was geographically widespread, but particularly devastating in some communities right here in New York City, including Breezy Point, the Rockaways, portions of Staten Island, and of course in many cities and towns along Long Island, New Jersey, and the Connecticut waterfronts, such as Long Beach, Seaside Heights, Spring Lake, and Hoboken. Estimates of the economic cost of the storm are still being tallied, but they are very significant. Estimates of the cost of disruption to economic activity, that is, services that couldn't be rendered and goods that couldn't be produced because of protracted transit shutdowns, power outages, and other damage produced by the storm, are also important and are particularly difficult to pin down in terms of making estimates. Thus, it's going to be some time before we really have concrete figures available about the full consequences of the storm on this region. However, the early read from recently released data do confirm that disruptions have been widespread. For example, every one of the New York City area firms that responded to our recent Empire State Manufacturing Survey, we asked the questions 1 to 2 weeks after the storm hit, indicated that the storm disrupted activity at their firm. And 40% of them indicated that they were either completely shut down or severely crippled for at least 5 days. Furthermore, the number of workers filing initial claims for unemployment insurance in both New York and New Jersey have surged to more than triple their pre-storm levels in the week after Sandy hit, suggesting at least 70,000 storm-related job losses in the 2 states so far. So these data suggest that the disruptions that we've seen and continue to see could be substantial. We can quantify the losses in terms of days of lost output. The regional GDP is about $1.4 trillion. So days work for the region as a whole would be about $3.8 billion per day of lost output. Now, a considerable part of this lost activity will be offset over time or replaced by a temporary shift of activity from the harder hit areas to those who have been less affected. But it's important to recognize in a service-based economy, much activity can't be shifted in time. Restaurants can't, for example, serve 6 meals a day to make up for lost business. The fact that many people who would have dined in Lower Manhattan in the weeks following Sandy are instead patronizing restaurants near their homes or near temporary work sites does represent an offset for the regional economy as a whole. But that's little consolation for the restaurant located downtown, which may need to lay off some of its people because of losses that it suffered and could even possibly go out of business. And this applies, I think, even more dramatically to businesses in particularly hard-hit areas along the regional shoreline. Now, against this, reconstruction did begin soon after the storm was over, and this is likely intensified since. The repair and replacement of damaged and destroyed infrastructure, homes, and businesses is likely to continue for some time. And programs will need to be well designed in order to achieve the maximum beneficial impact in terms of the rebuilding. For example, on the housing front, it'll be important to ensure that program design and funding recognize that our region has a wide variety of housing types, including multifamily and public housing, that are in need of repair post-Sandy. So a one-size-fits-all program may not work very well for our region. Now, past studies suggest that reconstruction spending provides a powerful stimulus to local economies, both in terms of its direct effects and its associated multiplier effects. Thus, I do think that reconstruction will provide a similar sizable boost to regional economic activity, and that boost is likely to continue well into 2013. Now, all this analysis has to be viewed as early and provisional, but putting all the factors together at present, I expect that the economic activity in our region will be shown to be adversely affected in October and November, but we'll start to see a noticeable rebound when we start to see the December data. Now, in addition to the economic costs in terms of less loss activity, of course, there's also the cost in terms of human hardship to the millions of people who were adversely affected, above all those who lost their homes and loved ones, but also the millions of others who were cold or without power for days on end, people who spent hours getting to and from work, waited in long gas lines, and experienced the stress of not knowing what was going to happen next. We're also tracking the impact of Sandy on schools and students. In New Jersey, 60% of the schools were closed for more than 1.5 weeks. The storm shut down all of the New York City schools for a full week, and many schools across the region remain closed the following week. Hardships borne by students and families are also reflected in the fact that post-storm, the attendance has been very, very low in some schools especially. The New York City Department of Education moved quickly to relocate schools from damaged buildings to temporary premises, so that enabled children to resume their studies pretty quickly. But even 2 weeks after the storm, schools that had to be relocated had attendance rates below 70%. That's a huge drop from regular attendance rates that are over 90%. Now, research shows that lost school days and relocations are problematic because they can impede student learning. Now, the good news is that the situation is getting back to normal every day, closer back to normal every day. Today, out of the 1,750 schools in New York City, only 9 remain relocated. Also, I think of particular importance is that the leaders in the education area, administrators, teachers, principals, and others, they've agreed to make up 3.5 days that were lost because of the storm. And I think it's impressive to see that people in the region are committed to making sure that students don't lose education time, which is very valuable for them in terms of their skill building. Now, in terms of the storm, I think our region must learn the right lessons from this experience. The storm did reveal significant shortcomings in the resilience of some of our private and public infrastructure, especially in 3 critical areas: power, transportation, and communications. So these are vulnerabilities that must be addressed going forward. Now, turning to the storm's effects on the national economy, I expect that we'll see a modest negative effect on annualized growth of real GDP in the 4th quarter of 2012. It's really impossible to calibrate this precisely at this juncture, but offering up a guess, I would guess it would be in the region of maybe a quarter to 0.5% drag on real GDP growth in the 4th quarter. It's important that the storm had a big footprint affecting much of the northeast corridor. This is a densely populated area accounting for about 15% of national GDP. And normal activity in the final days of October and the first days of November were severely disrupted. So that's the negative. The positive is that the disruption has subsided and we have gotten life more back to normal. So we've seen the effects of the disruption already in terms of economic indicators such as industrial production for October and initial claims for unemployment insurance during the first, second, and third weeks of November. Yet some of this economic disruption that was experienced here we could expect will be offset to some extent by stronger than normal activity elsewhere. For example, plants in Ohio and South Carolina are working overtime making electric generators, and that's going to actually boost their economic activity. Second, some types of disrupted activities, will be made up in the fourth quarter. People will buy cars, they will purchase homes, they will start houses. That will be delayed, but there's still quite a bit of time left in the fourth quarter to make up for that lost activity. And lastly, as I mentioned before, repair and replacement of damaged property is already underway, and that will offset some of the earlier loss in activity. This rebuilding should continue well into 2013 and beyond, and this will provide somewhat stronger growth than otherwise would have been the case. Indeed, economic studies of disasters in the U.S. and other advanced economies find that the long-term effects on national economies have typically been negligible. So given the resilience of the U.S. economy, I would expect the long-run effects of Sandy on the region and the country to be similarly very small. Now, even before the storm hit, though, it's true that the pace of U.S. economic growth was disappointing. We were all averaging only slightly above a 2% annualized real GDP growth rate since the recovery began in the middle of 2009. As a consequence, the national unemployment rate still is unacceptably high, and its decline during the recovery has been grudging. In addition, too many people are discouraged and aren't looking for work any longer, and this has depressed the labor participation rate and held down the official unemployment rate. Moreover, we have 5 million people that have been unemployed for 6 months or more. So while the job market has picked up some recently, its pace has been insufficient to materially change the labor market picture. Now, in terms of economic activity, there are a few bright spots. For example, the growth rate of consumer spending was a bit firmer in the third quarter. And another area showing improvement is the housing market. Housing starts and sales of new and existing homes are trending up gradually. And nationally, home prices have finally begun to rise. However, there are some things that are still on the negative side. Business fixed investment spending fell some in the third quarter, and new orders for non-defense capital goods suggest that we'll see continued softness for a while longer. Overall, manufacturing activity remains weak. This manufacturing slump stems from slower growth abroad and uncertainties about how the fiscal cliff in Washington will be resolved. On the inflation side of the ledger, despite sharp rises in energy prices in recent months, overall inflation, is measured by year-over-year changes in the consumer price index, they're still around 2%. And that's significantly lower than the rate of inflation a year ago. The signals from underlying inflation pressures, compensation trends, the longer-term inflation expectations are all fully consistent with our longer-run inflation objective of 2%. So as you know, in September, the FOMC took additional action to promote a more robust recovery in the context of price stability. And that we reaffirmed that decision at the October FOMC meeting. In addition to the $45 billion monthly purchase of longer-term treasuries that were already underway and scheduled to run through the end of the year, the FOMC commenced buying additional mortgage-backed securities at a rate of $40 billion per month. The committee said, quote, "If the outlook for the labor market does not improve substantially, the committee will continue its purchases of agency mortgage-backed securities, undertake additional asset purchases, and employ its other policy tools as appropriate until such improvement is achieved in the context of price stability." In terms of rate guidance, the committee said that it anticipated that exceptionally low levels of the federal funds rate would be warranted to, quote, "at least through mid-2015." Emphasizing that a highly accommodative stance of monetary policy would remain appropriate for a considerable time after the pace of the economic recovery strengthens. So what does, quote, "substantial improvement in the outlook for the labor market," unquote, mean to me? A key point is that I will be focusing on the labor market outlook, not just the current state. Therefore, I'm going to be looking at the growth momentum within the overall economy and a range of labor market indicators, including the unemployment rate, payrolls, the participation rate, the unemployment to population rate ratio, and job findings rates. Following the framework we set out in September, I'm going to be assessing the unemployment and inflation outlook in order to determine whether we should continue our Treasury purchases into 2013. We're going to continue to do our part to push the economy towards maximum sustainable employment in the context of price stability. Yet it's important to recognize that monetary policy is not a panacea for all that ails our economy. In particular, Congress and the administration must address the fiscal cliff in a manner that creates a credible framework for long-term fiscal sustainability. It's widely acknowledged that the large fiscal contraction associated with falling off the fiscal cliff would drive the U.S. economy into recession. The contractionary impact is likely to be larger than normal, because monetary policy is operating at the zero lower bound for interest rates currently. Thus, fiscal consolidation must be accomplished in a way that avoids derailing the economic recovery. The best way to do this is to craft a plan that starts small in terms of its near-term impact, then grows very substantially over time as the economy grows healthier. Of course, this requires that the longer-term consolidation has to be truly credible. It's also important in this regard that any plan have broad bipartisan support so that households and businesses understand that it will, in fact, be carried out. We saw in the summer of 2011, when the debt ceiling limit was in play, that a failure to come to grips with our nation's economic challenges and responsibilities can have a large effect on U.S. household and business confidence. We do not want to repeat this experience at the start of 2013. Moreover, what happens will influence how we are perceived in the rest of the world. When I meet with economic leaders around the globe, they do not doubt the underlying strength and dynamicism of the U.S. economy. They don't doubt the entrepreneurialism and the inventiveness of our people. Nor do they doubt that the United States has the resources and capability to overcome the challenges that we face. But they do wonder whether our political system is capable of putting the national interest above partisan interests and making the tough choices needed to address these challenges. If a credible bipartisan achievement is achieved, it will strengthen global confidence in the United States. And it will underscore to the world that our country remains a great place to do business and to invest in. Failure to reach a credible agreement would suggest a degree of political dysfunction that would undermine U.S. economic leadership and could encourage global corporations and investors to take their business elsewhere. Make no mistake, credible fiscal consolidation will not be painless, no matter what form it takes. The burden will be felt across many sectors of the economy, and we must expect that the resulting fiscal drag will exert some restraint on economic growth. Nevertheless, there is no reason why a carefully crafted plan would need to put the economic recovery at risk. A credible plan, after all, would likely have a very positive effect on confidence. In particular, I believe that business investment would respond positively to a credible plan. More generally, reducing uncertainty about future tax rates, entitlements, and other spending programs has to be positive in terms of reducing uncertainty that can restrain economic activity. By clarifying the rules of the road, a credible fiscal plan is likely to reduce the incentive of households and businesses to delay spending and investment, and this would likely offset fiscal drag to a meaningful degree. So to sum up, while it's still too soon to have a precise estimate of the economic impact from Sandy, I do expect a negative impact on fourth quarter national and regional economic growth, but a minimum long-run consequence both nationally and regionally. This has happened during a period where too many people remain without their jobs they need to help support their families and themselves. Although the economy continues to expand, we must grow faster if we are to put all our jobless workers and idle businesses back to work. Meanwhile, price increases are likely to be at or slightly below our 2% longer-run objective over the next few years. Many parts of our region are showing a stronger pace of growth than the country as a whole before the storms hit. And I'm hopeful that Sandy will not have pushed us off this trajectory for long. The recovery of housing markets are an important part of this renewed growth, although certain communities are still weighed down by lingering high rates of delinquencies and foreclosures, and some others have suffered appalling damage from Sandy. So going forward, let me reiterate that the Fed will promote maximum employment and price stability to the greatest extent that our tools permit, and we will stay the course. When we achieve a stronger recovery in the context of price stability, I'll view it as consistent with our goals and not a reason to pull back on our policies prematurely. If you're trying to get a car to get moving that's stuck in the mud, you don't stop pushing the moment that the wheels start turning. You keep pushing until the car is rolling and is clearly free. Thanks for your kind attention. Now I'll be happy to take some questions.
Thanks so much, President Dudley. That was fascinating. Let me start with a question about the New York economy and the level of unemployment here. What do your studies show about how much of the unemployment is structural in the sense of people with the wrong skills, the wrong educational background, and how much is due to the collapse of particular industries, real estate, finance, advertising, some of which is also structural change?
Well, I think it's fair to say that the unemployment has both cyclical elements and structural elements, and I think that a good chunk of the elevated unemployment rate, most of it is a cyclical phenomenon rather than a structural one. But I think you make a very good point that there is a mismatch always in the labor market between the jobs that are available and the skills that people have to meet them. And the educational community, I think, can play an important role in reducing that degree of mismatch. So one thing when I'm traveling around the region and I'm talking to people like you, is I'm always saying, you need to work as closely as you can with business to try to assess their needs, what type of skills do they need, and make sure that the curriculum and programs that you offer line up with those needs. Because to the extent that we can reduce the degree of mismatch, we can actually then operate the economy with a lower unemployment rate without actually having any inflation pressure. So it's a sort of win-win if we can do a better job of reducing mismatch.
Absolutely. You talked, I think, in a very interesting way about the elements of a sensible solution to our fiscal problems, the long-term deficit. That debate, in terms of the cost-cutting part of it, has tended to focus on entitlements. One of the effects, it seemed to me, of Hurricane Sandy, as you pointed out, was the extent to which it exposed the need for major infrastructure investment and also the vulnerability of our system. Not only things like power and communications, but the whole supply chain. I think I was struck by the speed with which gasoline disappeared from this region. It seemed to happen in a matter of days. And as you've just said, there's need for, I think, also major investment in educational infrastructure in this country. And worldwide, nationwide, we need massive investments in infrastructure because we have an awful lot of deferred investment in this country. Now, all of those are very expansive, and how do you see that need for investment fitting into the debate about managing the deficit and fiscal control?
Well, I mean, we have to be very smart about, what we spend on. I mean, there are certain expenditures that make the economy more productive, that eliminate bottlenecks, and those are kind of expenditures that we don't want to forego because they're actually going to allow the economy to grow faster over the long run and generate a higher standard of living for all Americans. There are other expenditures that are, more consumption-oriented, and those probably need to be scrutinized more carefully. I'm not going to offer any advice about what the fiscal package should look like in terms of composition. The Federal Reserve has a very completely apolitical stance on that. All I can tell you is that it's going to be important to get the U.S. fiscal house on order, because if you look at the long-term trajectory, the things do not look sustainable at all. And and some of it is in terms of entitlement spending, and it's due to the fact that the people are living longer, and the ratio of retired workers to workers is climbing. So that puts stress on the overall economy. I think these things are completely, I think the issue of, fiscal sustainability for the U.S. completely within our power to do. This is not a question of ability. It's not a question of fiscal capacity. It's a question about political will. So it's really a political question, not an economic question. And so I just encourage our leaders in Washington to come together and reach an agreement on something that is going to be a fiscal agreement for the long term rather than for the short term.
Just a short follow-up on the political issue. And it's a technical question, not a political question, but the debate in the Congress between Democrats and Republicans is in part centered around whether tax rates should raise or there should be controls on deductions, both of which would result in additional revenues. My question is, from a technical point of view, does the choice of one route rather than another have economic implications, or is it neutral?
Well, it certainly has economic implications, because if you cap deductions, then any area that benefits from that deduction is going to be, disadvantaged somewhat. I think economists as a group, and I can't really speak for all my fellow economists, but I'm going to anyway, probably view that a base broadening, having a broader tax base, is probably the most efficient form of tax regime. So I think most economists think that base broadening would be a good way to go. But that said, it's not like the level of marginal rates in the U.S. is at a particularly high level compared to the rest of the world. So I don't think that you would say that if you landed on one realm a little bit more than the other realm would have huge consequences for the economic outlook. So I don't think it's really so critical which one you pick, but the important thing is you have to pick.
Just one final question before we open to questions from the floor, and this has to do with the regulatory role of the Federal Reserve. Probably half a century ago, a former chairman said that the role of the Federal Reserve is to take away the punch bowl just when the party is getting good. We have had excesses in the financial markets about every 8 or 10 years for 30 or 40 years. And most of those have been managed fairly well. And it's a question of balancing free markets against excessive regulation. In 2008, things got very badly out of hand. There are a variety of new institutions, but my question most broadly is whether Americans can be reasonably comfortable that the next time this happens, somebody will take away the punch bowl.
Well, I think we absolutely will take away the punch bowl when the time is right. We have a dual mandate of maximum sustainable deployment in the context of price stability, but we also have a goal of financial stability. And I think we learned, in spades and very uncomfortably, that without financial stability, we can't achieve our other objectives. So financial stability is a very, very important part of what we do. At the Federal Open Market Committee meetings, we are always looking at the economy, at financial markets, to make sure that we're not sowing the seeds of some future, bubble or excess that could lead to future financial instability. So this is definitely something that's very much on our watch.
Okay, let me ask you for your questions. Just raise your hand. Wait. Why don't we start right here? Just identify yourself briefly, if you would.
Yes, sir. Good morning, President Dudley, President Friedman. My name is Cicely Bland. I am an alum of Pace University, currently an employee of the City of New York, more specifically the City University of New York, where we have nearly 500,000 students enrolled. And I wanted to ask, I didn't hear you talk about the impact of student loan debt on the region's economy, more particularly delinquencies. Do you have any statistics in terms of how we're doing as a region in terms of repaying student loan debt, and how the the interest rates are impacting our overall growth in the region as it pertains to that area?
I don't have anything to say on student loans from a regional perspective, but it's clearly an important issue nationally. If you look at the total loans outstanding for household debt, the only category that's really been growing, and it's been growing rapidly over the last few years, is student loans. And a lot of these student loans, a lot of them are troubled. I think, if I remember the numbers right, I think about 11% have problems. And that really understates the degree of stress in the student loan market, because for all those people that are still students and where their loan payments have been deferred, they can't be delinquent yet because they haven't really come due yet. So this is something that we are actually spending more and more time on, trying to understand the student loan market, what the problems are. And what it means for the economy and the economic outlook. So I think it's an important issue.
Just a short addition. The question of student loan debt is very much related to the state of the economy, and because it has to do with the ability of people to service the debt. Our student loan default rate is about 3.4%. That's a 3-year rate, which is quite low, among the lowest in New York. And part of the reason for that is because of the focus of education at Pace on preparation for professions. Our graduates tend to earn enough money to service their debt.
No, it just sort of emphasizes why getting a stronger economic recovery that generates more employment opportunities is really critical, because if people have jobs, then they can pay on their student loans. So job one for us is getting the economy moving and generating faster employment growth.
Next question. Yes, sir.
We're going to alternate. We're going to take that. Hi, my name is...
No, all right, go ahead. Yeah,
Go
let me recognize people. Okay. Go ahead.
My name is Corinna Sager. I'm an adjunct professor at Pace, and I teach international communications. And I would like you to elaborate a little bit on a global outlook for the future. One of the things that I mention is that there's a rising middle class that's coming out in Asia and even Africa and South America. If you can elaborate a little bit about that and how that actually has an impact on us developed nations and world trade.
Okay. Global economy is growing a bit more slowly this year, but it looks like some of the slowdown is, it looks like the slowdown is sort of bottoming out. China in particular, growth has slowed quite a bit. But the recent signs there are things that are stabilizing, and looks like growth is going to accelerate looking next year. And I think the important thing about the global economy is that we are in an increasingly complex and competitive world, and we need to, our standard of living is going to be driven by our ability to be productive, and our ability to be productive is going to be driven by the quality of how people are educated. And so we have to understand that we're competing with people from around the world. I think it's really an opportunity rather than something to be scared of. And I think that the other thing we need to do is be a little bit more aggressive about being outward looking in terms of looking for opportunities where we can sell our goods and services. One trip we made to Long Island, we went to tour a company that primary product is guitar strings. And they are the leading worldwide guitar string manufacturer in the world. I don't know what their market share is, but it's something on the order of 50, 60, 70%. And it was really interesting to think that the guitar strings that you're using anywhere in the world are being manufactured in Long Island. So it shows that there's plenty of opportunities for us to compete. And I think I think looking abroad for those opportunities to export, I think, is extremely important. And that's one reason why we sponsored some workshops, really trying to help small businesses figure out how they can actually sell their goods abroad.
Two nights ago, I heard the chief financial officer of a major American company speak, and he said, capitalism really sucks because everyone is competing with you all the time. You've got to innovate constantly. You have to be fully committed to continuous improvement. he was joking, of course. That is the great strength of our system, so it is an opportunity. Yes, sir. Question.
Michael Fazio, I'm an alum. A couple-part question with respect to financial stability. First of which, I think the U.S. debt is probably about 70% maturing in less than 5 years versus most developed nations are about 50% or less. So first part, what is your strategy on that? Second part, with respect to looking at the deficit and if you look at the entitlements and present value, some of those recent reports saying that the number is as high as $86 trillion. So in terms of financial stability, are our politicians, what can the Fed do to help push the politicians to really address this? $86 trillion is unsustainable and will crash the U.S. economy and financial stability. So what can the Fed do to push us in the right direction there?
Okay, well, in terms of, the maturing debt, I mean, maturing debt isn't a problem as long as you have a credible fiscal program. As long as you have a credible fiscal program, people are going to be happy to reinvest in your debt. So I think the important thing is not to be so worried about the fact that the debt is rolling over. The thing to focus on is to make sure you have a credible fiscal program over the longer term. Now, in terms of, the numbers that you cited, I mean, they're really scary numbers, the 60 trillion number. But you have to recognize that these numbers are based just on the current trajectory of current programs, and these programs can be altered and have been altered in the past. I mean, Chairman Greenspan, Alan Greenspan, chaired the Social Security Commission in the mid-1980s that basically changed the Social Security program in a pretty significant way and pushed back the timing of when Social Security was going to run out of money by several decades, and I'm sure we can do that again. So it's going to be necessary to change those cost curves for both Social Security and healthcare over time, I think. But this is something that's eminently achievable. And the reality is the U.S. situation isn't as dire as some other developed countries because we don't have as unfavorable demographics. And we're also a lot more welcoming to immigration, and so that means we actually have some dials that we can turn elsewhere that can actually affect our destiny.
Would you expand just a moment on the demographics issue, because countries like Japan, Italy, Russia have a grim future because of the shrinkage of their population and their dependency ratio.
Yeah, well, obviously, ideal, the sweet spot is when you have lots of workers to few retirees, and the unsweet spot is when you have lots of retirees relative to workers, and that's driven by two things. It's driven by fertility rates, immigration policy, and the third thing actually, longevity. So if you look at a country like Japan, they have low fertility rates, they have very long longevity, and they have very little immigration. So they're in a particularly difficult situation. The U.S., our fertility rates are considerably higher, I think 2.1, so we're pretty much right around replacement rate. And we have a much more willingness to accept immigration. So we have a transitional problem going to, in terms of having more retirees per worker. But I don't think we have a sort of a long-term structural secular problem. Once the baby boom generation retires, it sort of levels out, and so I think ours is actually pretty manageable.
Yes, sir.
Hi, I'm Alan Josephsek. I'm an MBA PACE of 82. My concern is I run a small business, and we have a lot of large clients, and their propensity to buy my services is lower for 2012, lower than any other year. My concern is the regulations going into 2013, because a lot of them are putting off their buying habits until 2013. So how do you see the impact of regulations such as Obamacare and other regulations impacting the growth of the economy?
Well, I think the big impact, I think, on the economy has really been felt in the second half of this year in terms of uncertainty about what's going to happen with the fiscal cliff and uncertainty about what was going to happen with the election and whether the election result was going to change what was happening in terms of healthcare policy or change what was happening in terms of financial regulation. Now that the election has been done, I think we have more clarity on that front. And hopefully we'll have a lot more clarity over the next few weeks in terms of what's having the fiscal outlook. A lot of businesses that I've talked to over the last few months have said that they're holding back in terms of hiring and investment because of uncertainties about the fiscal outlook. And that's understandable, given that if the fiscal cliff is resolved well, we'll do quite well in 2013. If it's resolved poorly or not resolved at all, we could actually be back in a recession. And so people don't want to proceed until they see that uncertainty resolved. So hopefully, over the next few weeks, we'll see that uncertainty resolved, and hopefully resolved in a good way.
We have time for one more question. How do I make this choice?
I think you have to go with the team, don't you? I think you have to go with the team.
You choose.
We have to go with the team.
The team.
So my name is Sophia Sternick, and I'm part of the Federal Reserve Challenge Team.
Bring
and something
the
that
mic closer, please.
something that we were really interested in asking about is the new Dodd-Frank regulation, and what's the impact of all this financial regulation in both the regional and national economy?
Well, obviously, some banks are unhappy with the fact that they're being required to hold more capital and more liquidity, and we're scrutinizing their business structure to try to make them simpler and less interconnected and more easy to resolve in terms of if they get into difficulty. I gave a speech just very recently, a couple of weeks ago, where I talked about the too big to fail problem, ending too big to fail in the United States. That's our goal. That has to be our goal, and we can't rest until we achieve that destination. Now, whether this is from a bank, I'm sure that they're uncomfortable with the degree of change, but given the financial crisis that we experienced, this is absolutely necessary. The losses that we experienced because of the financial crisis are enormous, not just to the financial system, but broadly to Americans. So this is something that we absolutely have to do. Now, in terms of what's the consequences on the U.S. economy from these regulations, I think that the consequences on the U.S. economy from these regulations have been very, very muted in terms of holding back the U.S. recovery. I think the U.S. banks are already in quite good shape in terms of capital and liquidity. When we look at our survey of senior loan officers, we actually see that credit conditions in the U.S. Are improving. Credit availability is improving. So, yes, I think it's not quite the Wild West was in maybe 2006. I don't want to go back to the Wild West, but I don't think it's going to really, I don't think these regulations are really going to impair the ability of households and businesses, with good credit to get credit in the future. So I don't think this is a bad thing, a road to go down at all. I think it's a very good road to go down, a very necessary road to go down. Now, obviously, as we do it, we're going to learn, in time over what regulations work best, and obviously things need to be modified based on experience. But make no mistake about it. The Federal Reserve Bank in New York and the Federal Reserve System as a whole, I will speak for the Federal Reserve System now, is completely committed to ending too big to fail. That has to be done.
President Dudley, thank you so much for a wonderfully thoughtful, interesting discussion. That was great. Thank you. Why don't we just take this off here?